Hello and welcome to Live Tutorial Tuesday. We will be working on part 5 of a comprehensive problem. If you've missed parts 1 through 4, that's okay. This will be a standalone part. In this part, we're going to be doing the closing process, which can be thought of as a standalone problem of the closing process, and it can be thought of as a process that's going to be part of the overall accounting cycle. We are going to do what we have done through the process here, which is to compare both the process of putting the information to Excel, which is more of a putting it in there just by working the calculations, and then we're going to put it in to a database type program being QuickBooks. The idea here being that we want to see both how to put it together, how everything links together in terms of the accounting and the theory of accounting, how everything ties together. Then we want to look at that same information with regard to a database program like QuickBooks so that we can then get an idea of how these two things line up, how they're going to be the same and the different. When I talk to both students and people that work in accounting and accounting departments or in other areas within accounting, often questions we get is how the theory is going to relate to the software. How much of the software is going to take over some of the theory? How much of the theory do we need to know if we have the software? And those types of questions usually don't get answered when we first start learning theory in accounting, because we start by just learning debits and credits, not usually often by working with QuickBooks. And on the other end of the table, we have a lot of people that learn QuickBooks before they start to learn accounting. And so they're looking at the other end, and they both have the same questions, which is, well, how do these debits and credits in the theory work in practice? And so this problem, hopefully, we're going to go through here and answer some of those questions. What do we need to know? What don't we need to know in terms of theory for some different areas of accounting? So there's going to be a worksheet in the description that will have a link to an Excel sheet that we can take a look at and work through the problem if you so choose. At the same time, there's also going to be a link to the another worksheet, which is a Google Sheets worksheet, and that's another worksheet that can be used. That's free. Free Google Sheets is free, so you can take a look at that. If you don't have Excel, that could be useful. There's also a QuickBooks Backup file. You would need QuickBooks in order to restore the backup file. I don't expect everybody to have QuickBooks. That's okay. We can just use QuickBooks as kind of the idea of here's the theory, here's what it would look like in a database program as we go. We've gone through our set of questions. We're going to have the same set of questions all the way through, or the same set of data that we're going to ask ourselves as we're entering this information. We're just going to keep repeating the stuff. This is the core kind of theory stuff, how do debits and credits work, and we'll just keep repeating this as we go through all the debits and credit type of transactions. The board's going to be this. We just need to basically memorize the normal balances of debits on the left, credits on the right, and what type of accounts are debit and credit balances. So we've got assets or debit type of balances, liabilities or credit type balances. Equity in terms of retained earnings is going to be an equity or a capital account. We have the income statement accounts, which are kind of a part of equity as well. Revenue is going to be a credit. Expenses are debits. Once we know that or have a cheat sheet for that, our cheat sheet through this problem will be the trial balance, which I recommend having available all the time. Even if a problem doesn't give it to you, I would open a different problem to have the trial balance open all the time. Then if we do that, once we know those normal balances, we can say, okay, what are we trying to do here? Are we trying to make an account to go up? Then we do the same thing to it. If we're trying to make it go down, we're going to do the opposite thing to it. So if it's a debit balance account, we're trying to make it go up, we're going to do the same thing to it, which is a debit. If it's a debit balance account and we're trying to make it go down, we're going to do the opposite thing to it, which is a credit. If it's a credit balance account and we're trying to make it go down, I'm trying to make it go up, we're going to do the same thing to it, which will be a credit. If it's a credit balance account and we're trying to make it go down, we'll do the opposite, which is a debit. I know that's confusing sounding, but we're just going to keep repeating those. They're pretty simple rules that we can kind of get down just through repetition. The worksheet that we're going to be working with will look like this. Again, there's going to be a worksheet in the link below that you can work both in terms of Excel as well as Google Sheets. The Google Sheets, if you wanted to go in there and copy the worksheets, you can have your own copy of the worksheet, or you can actually work it live if you want. If you want to actually work that Google Sheets that is there, then we can work through the problem live as we go if anybody wants to do that. The other pieces of the worksheet, you don't need these other pieces, but this is what we have done last time. Again, this is a standalone problem, but if you want to see what happened last time, you can go to the live tutorials 1 through 4, and what we've basically done is the accounting cycle. We started entering the data here, entering the journal entries, then we did the adjusting process, then we took this adjusting trial balance and we made financial statements from them, a balance sheet, an income statement, a statement of equity, and then now we're doing the closing process. This will be the process to close out the month. We're going to do the same information. We've done the same information in QuickBooks here. So QuickBooks, I've got 3 reports open. There's a QuickBooks backup file if you wanted to open QuickBooks. Again, you would need QuickBooks, so I don't expect everybody to have QuickBooks, but if you do, you can go through here and open this up. I really just want to go back and forth to QuickBooks to just show how the same data is being represented in terms of putting it into the data of a database program like QuickBooks, and how QuickBooks will compile the data into financial statements in a similar way that we will be compiling the data. So we've put all the data into QuickBooks at this point. QuickBooks is, and so we're kind of done with QuickBooks now. What we want to do is see how QuickBooks is compiling this data, and we're going to compile it and see how QuickBooks is doing it, how QuickBooks is working, so that if there's problems, just like if there's problems when we put something into a calculator, if we say 20 times 20 and the answer comes out to be 2, then there's a problem. And so we got to know that there's a problem with the data that has been input. Similar to QuickBooks here, we don't want the financial statements to be a magical thing that just kind of gets generated. If we put in data, we want to know how the data's related. And so that's what we're going to do here. In terms of the closing process, QuickBooks has some, we'll see how kind of some quirks that QuickBooks can have and some of the problems that QuickBooks will have when we do the closing process, or think about how the closing process is set up by default in QuickBooks. Okay, so I'm going to check a few things. I'm going to see our first comic, and I'll be right back. Okay, so let's get back to Excel here. We're going to work through Excel. This is going to be the closing process. We're going to enter the closing journal entries and then check out how that process worked in QuickBooks as well. This is going to be the last piece of our process here for our cycle, our monthly cycle that we're going to go through. Obviously, this cycle will repeat. Once you've done this a few times, especially at the same company, then it becomes a lot easier to do, clearly, because you've seen what's going on a few times. So what we've done is we've entered the journal entries, and like I say, the journal entries month after month are going to be largely the same. So we'll be able to see some of those journal entries repeat. If we're using software like QuickBooks, then QuickBooks will actually help us to re-enter a lot of the data because it'll memorize what happened last time. We then did the adjusting process. The adjusting process meaning we want to set things up on an accrual basis so that we can create the financial statements. And then we, of course, created the financial statements, that being the end objectives. Financial statements being used by management, but also by external users. The design of the financial statements from a publicly traded stock standpoint is for external users, because we really want those financial statements to be usable by external users. Therefore, it has to be standardized. It's also the same data is used by internal users, but managerial accounting can do different things with it. But at the end of that, once we do the financial statements, we then need to change or set up our data for the next time period. And the key to this is that some of these accounts are temporary and some of these accounts are permanent accounts. And we need to close out the temporary accounts so that we can move forward to the next time period. So it's just like running a race here. If we had a stopwatch and if we're trying to see how far a distance is, how far we can go within a certain period of time. If we're driving and we're trying to see how far we can go in a day, well, if it's day 2, then we need to reset the odometer. We need to start at 0, and we need to start driving on day 2 to see how far we're going to go and count upwards. Or else we can just, see where we're at the end of day 1 and then, subtract the 2. But it'd be nicer if we can just restart the odometer, and that's kind of what we're going to do here, and restart the odometer and start day 2 from 0 and see how many miles we drive. That's what we need to do for all temporary accounts. It can be confusing to try to think about, well, which accounts are temporary and which are not. But it's really not that difficult, especially if you have the trial balance, because basically everything under the equity section is a temporary account, meaning the entire income statement, revenue and expenses are going to be temporary accounts, as well as anything under, in this case, the owner's capital account, so draws and income summary. All right, so we're going to close those out. And hold on just a second, I'm going to take a look at something. One more comic. All right. Okay, so we're going to close out everything from the income statement and the draws, and anything under the capital account needs to be 0, and we need to put everything basically into the owner's capital. Therefore, we can start the next month, in this case the month of June, starting at 0 in a similar way as we would if we were driving and trying to see how far we can go during a certain time period. So there's a couple ways we can do this. Obviously, this could be done with just one journal entry. We could just say, hey, whatever's in here, we need to clear it out and we need to put it into basically the capital account. We could just do it with one entry. Typically, we do this with a 4-step process. I call it a 4-step process, and we're going to use an income summary account. It's important to know this because a lot of textbooks will do this, and if anybody does the closing process in this way, they'll often talk about the income summary account as if it has net income in it. And a lot of textbook problems will talk about the income summary before you close it out to the capital account, and talk about the idea that net income is in that. And this becomes really important when we're talking about things like partnerships rather than a sole proprietor here, because partnerships are going to have multiple partners, and we have to basically split income between multiple partners. Same with corporations who have more than one stockholder. So the equity section and splitting up the revenue to the proper locations within the equity section becomes important. So that's what we're going to do. We're going to do a 4-step process. We're going to use this income summary account. I call this a clearing account, and we're going to put basically the entire income statement into the income summary, which means net income will be in the income summary. Then we're going to take net income and we're going to apply that out to the capital where we ultimately want it to go. And then we're going to close out every other temporary account, which is not part of the income statement, which in this case is just draws. So we're going to close out draws also to the capital account. All right, so let's do that. First step of the 4-step process, and it's all going to be as of the end of the month because this is the closing process. And obviously, we're not actually at the end of the month when we do the closing process. It's sometime afterwards. We've done the financial statements. We've done the bank reconciliations. That would have taken time. So we're going to put the closing process as of the end of the time period. Remember, in real life, in real time, we're doing this at some point after that point. All right, so revenue, we need to make that 0. So we're going to go through our questions here. We're going to say revenue. It has a credit balance represented by the fact that it has brackets around it here. I need to make it go down because I want it to go to 0. Therefore, we're going to do the opposite thing to it, which in this case will be a debit. So I'm going to debit revenue. So I'm just going to copy revenue, right-click and copy. I'm going to put it in C5, right-click and paste it 1, 2, 3. And the amount's just going to be for 8900. Then there's only one revenue account, so we're going to debit that, and we're going to have to credit something to make that go away, to get that going down to 0. So there's got to be a credit in our closing journal entry. What will that credit go to? ultimately it's going to be in the owner's capital account. But before we get there, we're going to first go through the income summary account. So I'm going to put it into the new clearing account income summary, copy that. I'm going to paste it in C6, right click and paste it 1, 2, 3. So there's our first journal entry, 1 of 4. First journal entry of 4 in the 4-step closing process for the month. We're going to post this out now. I'm going to post this just to a quick worksheet, not to a general ledger, but just show the activity to see the beginning trial balance, what we're going to do in the blue, and then what happens in the end. All right, so we're going to be here. Let's do the income summary first in I-17. So I'm just going to say I-17 equals, and then point to the income summary, which is the credit, and enter. And so that puts that 8,009 into the income summary from 0 up 8,009 in the credit direction to 8,009. Then we're going to go to revenue. What do we want to happen? We want revenue to go to 0 because we're trying to clear this thing out to 0. So I'm going to say equals and point to that debit. So this is a credit, that's a debit. Those are opposites. That means this 8,9 will go down to 0. So that's what we wanted. We've accomplished the first task. We've made revenue go down to 0, and we just put the balance into this income summary temporarily until we finally get it to where we want it to go, the owner's capital account. So the next step, and note that we're not going to go back to QuickBooks basically until we're done. This is something that QuickBooks does but doesn't do perfectly, or at least we need to know how QuickBooks works in kind of the default settings of QuickBooks. And so we'll get to that after we're done with this. Next, we need to close out all the expense accounts. Now, this one gets confusing to people because there's a lot of expense accounts. Obviously, there's more expense type of accounts than other account types, than any other account type. But they're all the same. They're all going to have debit balances, and they all need to go down. We need to make them all go to 0. We're going to do that with one journal entry that will include all the expense accounts. And making sure that we get all the expense accounts is one of the reasons that we could use, that is the reason for using an income summary clearing account rather than just closing it out to the capital account. All right, so I'm going to do this kind of one at a time and just say why we're doing this as we go. So I'm going to just build up and post as we go this journal entry. So we've got salaries expense here. We need to make that go to 0. It has a debit balance, as all expenses do. Therefore, we need to do the opposite thing to it, which in this case would be a credit. So I need to make that go to 0. I'm going to credit it. So I'm going to copy that. And I'm going to put it underneath, because credits usually go on the bottom. So I'm going to put it underneath here so we can put a debit on top. And there is that. And the amount's going to be a credit. I'm going to put it as a negative for our credits for our worksheet purposes here. So it'll make the worksheet a little bit easier to use. And then we can just post this out. So I'm going to go down here and I'm going to post it as we go. Of course, the journal entry up here, not done yet, but we're going to post it as we go and see if it does what we want it to do as we go, and then do what we need to do from there. We'll try to build this up and do what we need to do from there. So we're going to be here in the salaries expense. I'm going to say that equals and point to this. This is a debit, that's a credit. This should go down then, the salaries expense, to 0. So that looks good. All right, and then we're going to do the next one. We're going to say this is the rent expense here. Same thing, it's going to be an expense account. It has a debit balance, as all expense accounts do. We need to make it go down. Therefore, we're going to do the opposite thing to it as what it is, which in this case will be a credit. So I'm going to do the same thing. I'm going to copy this. I'm going to paste it right underneath, right click, paste it to 1, 2, 3. And the amount in E10 will be a credit of 2,000. All right. Then we're going to post that, and obviously we're out of balance. That's okay. We're going to just post this as we go. So we'll go down here. I'm going to say this equals in I-20 equals. Going to point to that 2,000. Our objective is to make this go down to 0. Let's see if that happens. There it goes, down to 0. That's what we want. So we can now move on to the next one. Next one says supplies expense, 400. Again, we want to make it go to 0. It has a debit balance, so how do we make it go down? We do the opposite thing to it as what it is, which in this case is a credit. So I'm going to copy that, going to paste it in C11, right click and paste it 1, 2, 3. And the amount is 400, so we're going to put the 400. I'm just going to say negative of 400. And once again, the journal entry is not complete, but we're going to post it as we go. So in I-21 equals, I'm going to post this piece of the journal entry, this 400, then hopefully goes down to 0. All right, next item, depreciation, another expense, another debit balance account, another account that we need to make go down to 0. Therefore, we're going to do the opposite thing to it as what it is, which in this case will be a credit. So I'm going to go ahead and copy that. Going to paste it in C12, right click and paste it 1, 2, 3. Amount will be credit of 300. All right, and then I'm going to post this once again as we go. So I'm going to go down here to I-22. We're going to say that equals, point to that 300, and once we hit enter, that 300 should go down to 0. All right, then we got 2 more here. Insurance expense, again, another expense, another debit. We need to make it go down. We're going to do the opposite thing to it, which in this case will be a credit. So I'm going to copy the insurance expense. We're going to paste it in C13, right click, paste it 1, 2, 3. The amount will be credit 200. So we just got all these credits here. We're going to worry about putting it in balance after we have completed our task of making all the expenses 0. So in I-23, I'm going to say that equals and point to that 200. And this 200 then should go down to 0. All right, one more. We've got the miscellaneous expense, also an expense account, also a debit balance, also wanting to go down to 0. So we're going to do the opposite thing to it, which in this case will be a credit. So I'm going to copy that miscellaneous expense, go to C14, right click and paste it 1, 2, 3. Then we're going to go into the credit item, the credit column, and say negative 780. And there are all of our credits, so we just need to post that out. So in I-24, I'm going to say that equals and point to that 780, and that should hopefully go down to 0. Okay, so now we've posted all the expenses. We've got all the income statement 0, but we are out of balance because we just put all these credits in there. We don't have a debit. Where do we want that ultimate debit to go? Once again, ultimately it's going to go into the capital account, but first we're going to put it into income summary. So these are all credits here. We need a debit to balance this out. If I highlight these items in Excel, we can see that that debit should be for $5,216. I'm going to do that with a formula here. So I could equals the sum. If I equal the sum of all these, and I'm just going to highlight all of it from the bottom up, not worrying about this. You can move this, by the way, if that's in the way. And if we do that, it'll sum it up, right? It sums it up for us, but it's a credit represented by negative number in Excel, and we want to make it a debit. So one way we could do that is I could double click on it and put a negative in front of the sum, and that'll basically say, hey, multiply times -1 Excel, or flip the sign, and Excel will then do that, and flip the sign. There's the 5,216. We can do that in a quicker format by just saying, instead of equal sum, just negative sum. And then highlight these items and enter. All right, so now we're going to post that out. Now there's something here, there's something already in this cell in I-17. So I'm going to double click on that and go to the end of it, E6, say plus, and then point to this 5,216. And I know I didn't put the name there yet, but I'll do that in a second. So we're going to say enter. Once we hit enter, this number will go down, put us back in balance down here. There we have that, and I'm going to copy the income summary. That's what this debit should be. Paste it 1, 2, 3. And if we want to indent the credits, I could go up here and indent the credits by going to the Home tab, Alignment, Indent. These are all credits, home tab, alignment, and indent. All right, let me check something. All right. Okay, so now we have this. These are all at 0 now. And this number then should look familiar. That number now that's in the temporary income summary account is now going to be net income. So we have net income in the income summary. This is nice to have because we can kind of check ourselves now. We can say, okay, is that what should be happening? Meaning, are all the accounts below the or in the income statement revenue expenses 0? They are. And is the amount in the income summary the net income that was reported on our financial statements as of the end of last year? It is. Therefore, we can take that number and now close it out to the owner's capital account and be somewhat confident that that's correct. So now we're going to do what we wanted to do, the third step of the 3-step process. It's also going to be as of the end of the month, 5/31. We're going to take this amount and make it 0, put it into the owner's capital account. So this income summary account has a credit balance. We want to make it go down. Therefore, we're going to do the opposite thing to it, which in this case will be a debit. So I'm going to copy the income summary, right click, copy that, put it on top, right click, paste it, 1, 2, 3. And the amount will be for 3684. And then we're going to credit this same amount, credit of 3684. And it's going to go into finally where we want it to finally go, to the capital account in this case. So I'm going to copy that, right click, paste it, 1, 2, 3. Now this is a sole proprietor. If I'm going to go to the home tab, alignment, and indent. If you were in a partnership, then we'd have to allocate it to multiple capital accounts for the 2 partners, or multiple partners, more than 2 partners. If it was a corporation, it would be going to the retained earnings account. Concept is all the same though. It's all going from the temporary accounts into the equity section of a balance sheet or a permanent account. All right, so let's post this out, see if it does what we want it to do. What do we want it to do? I want this to go down to 0, and we want to put it into the capital. So I'm going to double click here. We're going to go to the end of this, and we are going to say plus and post this amount here in D16 and enter. There we go down to 0. So now we've closed out the income summary. We're going to go into the capital I-15 and say that equals and post to, or point to, the capital 3684. That should make this 50,000. That's a credit. This is a credit. It's going to go up. And that should make sense because that represents the book value, the assets minus the liability, or it represents what is owed to the owners, the residual, basically, assets minus the liabilities, and it went up by the net income, what was generated, what was earned last time period, last month. All right, so now we're almost there. We've got one more of the 4-step process on 5/31, last 4th step of the 4-step process. All of these are 0. That's what we want. Now we just want the draws to be 0. So draws, that's what the owner drew out. In a corporation, we'd have dividends. We need to make it go down to 0. It's a temporary account. Therefore, it's a debit. We need to do the opposite thing to it then, which in this case would be a credit. So I'm going to say draws. We're going to copy that. Last step of the 4-step process, we're going to put it underneath the date because it's a credit, and credits typically go on the bottom. I'm going to go ahead and indent that now as we go. Home tab, alignment, and indent. And the credit's going to be for a credit, negative 1200. Then we're going to debit where we want it to go, which in this case will be the capital, because once again, the capital is going to be reduced by the amount that was taken out by the owners. So I'm going to go ahead and copy the capital, put that on top on the debit, right click, paste it, 1, 2, 3. and there we have that. So that amount's going to be 1200, and I'm missing a 0. Notice if I post this out, it's going to be wrong, right? If I do it, I can see that an error's been made here. If I go to I, and say this equals that 1002, and say did that go down to 0? No, it didn't, right? So that's one way we can kind of catch these errors. So I'm going to say it needs to be a credit, negative 12000, 12,000, and 12000, and that automatically posts over here and makes it go down to 0. All right, and then we're going to put it into the capital. So there's already something in capital, so I'm going to double click on it, go to the end of it, plus, and then point to the capital. This is a credit, this is a debit. It should make this account go down. So now it went down by the amount that was drawn out. Notice that more was drawn out than was earned during the month. That's okay, we still have a credit capital account. Why? Because there would be prior months of income sometimes, or in this case, there are prior investments that are over the amount of revenue. So we're still good here. We still have more assets than liabilities, even though we drew out during this particular month more than we earned during this particular month. Okay, so that's what we have here. Now this is going to be what we call the post-closing trial balance, where we have the balance sheet side of it, and we have no income statement accounts. Why? Because we're starting the new month of June, and we want to start all the temporary accounts from 0 counting upwards. So that's going to be the goal here. Notice that this 4-step process is very similar to the financial statement process that we looked at, and the generation of the financial statement number, especially in the statement of equity. This is what will tie into QuickBooks. So this capital account, notice what is happening here, is that we closed out to that capital account the net income, went into income summary and then into the capital account, and then we closed out the draws. And that's exactly what we're going to do in the statement of owner's equity when we started with the beginning capital, which is 50,000, and then we increased it by net income, which was this 3684, and then we reduced it by the owner's capital. Now the only other kind of tricky thing that we need to know sometimes, and this particular case was the case, is that there was an investment of 50,000 because this was the first month. Many months there won't be an investment because the company hopefully is making money and the owner's taking money out, not putting more money in on the investment. But the only way to know that is to check the capital account. But in any case, this closing process is similar to the financial statements, and looking at that statement of equity in terms of this section, we're left with then just the balance sheet, just as of this point in time. So given that, let's see what QuickBooks does. Remember, all the data is already in QuickBooks. Now we just want to look at QuickBooks and say, how is QuickBooks dealing with this this timing difference, this closing process? QuickBooks tries to, on a default settings, make it automatic. They try to just say, we don't need to do these closing entries in QuickBooks, but there's some kind of tricky things if we're running in that case. So this is the trial balance as of 5/1 to 5/31. That's the month that we entered the data for. Now, we're not going to go in here. We could, but we're not going to go in here and say as of 5/31, enter all the closing entries. Again, we could do that, but if we don't do that, QuickBooks will kind of roll over the closing process, but it does it yearly. So when we put this information into QuickBooks, typically we're going to put the yearly information in there, meaning if it's a calendar year end, the year end should end on December. And therefore, QuickBooks basically just assumes that we're going to have the time period of the year, and then it'll roll over for us in December. It kind of just automatically does that. So by default, most small businesses are basically just going to run QuickBooks in a default setting like that and may not be entering closing journal entries as of 5/31. So let's just see what that does and the pros and cons of that. So first off, notice that when we close out the journal entries here, that means that as of 6/1, we'll have all zeros in the income accounts so that we can move forward to the next time period. Here, obviously, if I say that we're on 06/01 17 06/30 17, the next month, we still have these expense account numbers here. QuickBooks hasn't taken those numbers out because QuickBooks is basically not going to close out automatically except on a yearly basis. So, if I put the same numbers in here as of 01/01/18 next year, 01/31/18, then we're saying, okay, now it only has basically our post-closing trial balance, because it now rolled over as we would expect after the closing process, all of the temporary accounts into the equity section, which is now the 53,684, and not exactly what we have here. I don't know why. Oh, the draws is still not in there, so we've got, they're keeping the draws. 53,684 minus the draws is 41,684, and that's what we have here. So we closed out the draws, and that's another kind of thing that QuickBooks is a little bit different than the financial accounting as they would be reported on financial statements oftentimes, where we would close out the draws. QuickBooks is going to keep the draws in there. So QuickBooks will do the closing process, and if you're a small business and you don't want to you don't want to worry about the closing entries, the QuickBooks will basically do that. But there's some kind of things to be aware of, this being one of them, in that you got to be able to understand, if you're looking at a trial balance, what it's doing. Let's look at the financial statements that most people are going to look at when they're analyzing their data. Here's going to be a balance sheet. Again, it's as of 5/31. And this is our balance sheet as of a point in time. So we have our assets here, we've got our liabilities and our equity. If we look at our trial balance, we had our assets up here adding up to 4660, our liabilities adding up to 4376, and the equity at the 41,684. So that should be the same here. We've got our assets 4660, liabilities 4,374, and the equity 41,684. The funny thing here with this particular report about QuickBooks, which is different than normal financial reporting, is that QuickBooks is using this equity section to kind of break out the equity. So we have the 12,000 draws here, and we have the net income, which are built into the equity section. So they're showing the timing accounts here within the equity section. So let's see what happens if we then go to the next month, where you would think that we would just have one number down here if we were closing out the month of May and going to June, as we have done on the Excel worksheet. So if I go to 6060117, and we have the same information here because nothing has happened in terms of the point. We haven't entered any more data later. But if I go down here, notice we still have this same breakout. We still have net income being 3,684, and that's because it's basically taking it by a yearly basis. Now again, you could go into QuickBooks and change the date ranges. I can go to Customize here, and notice QuickBooks has a date range for the balance sheet, even though the balance sheet is typically as of a point in time. But even if this date range is 6/1 to 6/1, and even then it still shows net income for the year, right? And if I went to the next year, we would say 01/01/18. Then what it's doing, it's still breaking out the draws. It doesn't close out the draws still, but now it doesn't have any of that net income. We're still at this total 4660, but now it's basically closed out net income, and it's saying, hey, now we're in 2018, and we need to start counting up from 2018, and so the net income, any net income from 2018, will be broken out in that format. So, and then let's look at the profit and loss, which is the income statement. This is as of the month we worked on, so we've got the 8,009 and all the expenses. That's what we had in our beginning numbers here, 8,9 minus all the expenses, revenue of 3,684, revenue 3,684. That's going to be obviously the revenue minus all the expenses. Now, this account is the account that will act like we expect it to act. This is our timing, basically, account, right? So if we say it's as of 5/1 and I set a different date range as of 06/01/17 to 06/01/17, then we don't have any data. So this statement will close out just basically based on the date ranges, and QuickBooks is going to say, there's no data in there. It closed it out to 0, just like we would expect to happen on the income statement account. So those are going to be some of the things that the way QuickBooks can close out the process. We just need to know how QuickBooks is going to work so that when we generate the reports, this will happen. Also note that if we enter data into QuickBooks, say it's at the end of the year or the end of the month, and we made financial statements, and then we did something to a prior month in QuickBooks, like deleted a check or voided a check, that is going to cause us a problem because, for a small business, if we did the tax returns as of the end of last year, and then we canceled the check prior to the close of the year, then when we do the tax return this year, what will happen is retained earnings won't roll over because we made a change to a prior time period. So that's a big deal normally in the accounting departments, because if we're making financial statements, the retained earnings of last month have to match the retained earnings of this month. And if we go in there and change data from a prior time period, the retained earnings from the reports that we generated will no longer match. Meaning, if I ran a report for 05/31/17, and then we used this report to make financial statements outside of QuickBooks, and then the next time period came along and we had changed or deleted a check, voided a check prior to this time frame, then this report, even if we ran it as of the same date, will no longer have the same numbers in it, and that's going to be one of our problems. Now, on a tax basis, if you're a sole proprietor, oftentimes the balance sheet isn't reported, so it's possible that those errors won't be picked up. If you have to report the balance sheet, depending on what type of statement what type of tax return you're using, or if you have to report financial statements, then it's gonna be a problem if the retained earnings don't roll over. Those are some things to be careful of. So you want to be careful to go and backdate anything within QuickBooks if there's no restrictions, or even if there are. If the month has closed, you want to be careful on deleting stuff in the prior month. So those are how they compare out, and some of the differences between QuickBooks and just basically the theory of closing out the accounts from month to month.